For over 150 years, one name has stood the test of time in American finance: Prudential. From the Gilded Age through 2 world wars, the Great Depression, multiple recessions, and the 2008 financial crisis, Prudential Financial has maintained one of the most remarkable dividend traditions in corporate history. But this isn't just a story about payments to shareholders. It's a story about survival, adaptation, and what separates a truly resilient company from those that crumble under pressure. Today, we're analyzing every era of Prudential's dividend history: the growth years, the crisis moments, the cuts, and the comebacks. Whether you're a PRU shareholder, a dividend investor, or just fascinated by financial history, this deep dive will change how you think about dividend safety and corporate resilience. Let's begin at the very beginning. Prudential Insurance Company of America was founded in 1875 in Newark, New Jersey, during America's rapid industrial expansion. The company's early mission was straightforward: provide affordable life insurance to working-class Americans. But from the very beginning, Prudential operated on a principle that would define its next century and a half: financial stability and conservative management. The company began paying dividends to policyholders in its mutual insurance structure. These weren't dividends in the modern stock market sense. They were surplus returns paid back to policyholders who owned the mutual company. Through the 1880s and 1890s, as America industrialized and cities grew, Prudential grew with it. The famous Rock of Gibraltar logo was adopted in 1896, symbolizing strength, stability, and permanence. Even during the Panic of 1893 and the economic turmoil of the early 1900s, Prudential maintained its financial commitments. This wasn't just good business. It was building a reputation. The Great Depression tested every financial institution in America. Banks failed. Insurance companies collapsed. But Prudential, with its conservative investment approach and strong reserves, survived. During the 1930s and 40s, while dividends to policyholders fluctuated based on company performance, Prudential never defaulted on its core obligations. This established a culture of reliability that would carry forward for generations. For most of its history, Prudential operated as a mutual company owned by policyholders, not shareholders. That changed in 2001 when Prudential completed one of the largest demutualizations in insurance history, converting from a mutual company to a publicly traded corporation. On December 13th, 2001, Prudential Financial Inc. began trading on the New York Stock Exchange under the ticker symbol PRU. This was a pivotal moment. Now, instead of paying policy dividends to mutual owners, Prudential would pay quarterly cash dividends to public shareholders. The first quarterly dividend as a public company was modest, just 10 per share in March 2002, but it marked the beginning of a new chapter. Wall Street would now scrutinize every quarter, every earnings report, and yes, every dividend decision. The early 2000s were growth years. The economy was recovering from the dot-com crash. Insurance and financial services were booming, and Prudential was executing well. From 2002 to 2007, Prudential increased its dividend steadily, coming to 0.40. Per share annually 2003, 0.53. Per share 2004, 0.68. Per share 2005, 0.92. Per share 2006, 1.15. Per share 2007, 1.45. Per share, that's a compound annual growth rate of over 25%, exceptional growth that rewarded early investors who believed in the newly public Prudential. But storm clouds were gathering. 2008 was the ultimate stress test for financial institutions. Lehman Brothers collapsed. AIG required a government bailout. Bear Stearns vanished. Merrill Lynch was sold in a fire sale. The entire financial system teetered on the edge of collapse. Insurance companies, especially those with significant investment portfolios and exposure to mortgage-backed securities, were under immense pressure. Prudential, like its peers, saw its stock price crater. From over $100 per share in early 2007, PRU fell to under $15 in March 2009, an 85% decline. The critical question for dividend investors: would Prudential cut or suspend its dividend? Many insurance companies did exactly that. MetLife cut its dividend in half in 2009. Hartford Financial suspended its dividend entirely. Lincoln Financial slashed payouts dramatically. Prudential took a different approach. In early 2009, Prudential announced it would maintain its quarterly dividend at 0.37 per share, the same level it had held since late 2008. This wasn't an increase, but it was a statement. Prudential believed in its balance sheet strength and long-term stability, enough to maintain shareholder returns even during the worst financial crisis in 80 years. However, they did reduce the dividend from the 2007 peak of 1.45 annually down to 0.54 annually in 2009, a roughly 63% cut. It was painful, but it was also strategic. Management preserved capital, maintained regulatory requirements, and kept the dividend above zero. a signal that they believed recovery was possible. And they were right. As financial markets stabilized and the economy recovered, Prudential began rebuilding the dividend recovery. Timeline 2010-073, per share, 35% increase from 2009. 2011, 1.15 per share, 58% increase. 2012, 1.45 per share, 26% increase. 2013, 1.73 per share, 19% increase. By 2013, Prudential had not only recovered its pre-crisis dividend, but exceeded it. Throughout the 2010s, Prudential demonstrated disciplined capital management. 2014, 217. Per share 2015, 250. Per share 2016, 280. Per share 2017, $3. Per share 2018, 350. Per share 2019, $4. Per share from 2010 to 2019, the dividend grew at a compound annual rate of approximately 18%, a remarkable recovery story. During this period, Prudential also implemented substantial share buyback programs, returning even more capital to shareholders while maintaining dividend growth. The company's core businesses, U.S. insurance, retirement solutions, and international operations, performed well. Interest rates remained historically low, which challenged investment income, but Prudential's diversified business model provided stability. By 2019, Prudential's dividend yield hovered around 4 to 5%, making it attractive to income investors, while the payout ratio remained sustainable at around 30-40% of earnings. Then came 2020. March 2020 brought another crisis, the COVID-19 pandemic. Markets crashed. Economic activity froze. Mortality concerns spiked for life insurance companies. Once again, dividend investors watched nervously. Prudential's response was measured. In May 2020, management announced they would maintain the dividend, but pause increases temporarily to preserve capital during uncertainty. The annual dividend for 2020 remained at $4.40 per share, a modest increase from 2019, signaling confidence but also caution. As the pandemic's financial impact became clearer and markets recovered, Prudential resumed modest dividend growth. 2021, $4.60. Per share 2022, $4.80. Per share 2023, $4.90. Per share 2024, maintaining $4.90 per share as of latest data. The growth rate has slowed compared to the 2010s, reflecting both market maturity and management's focus on capital preservation in an uncertain environment. Prudential's current dividend yield sits around 5 to 6%, depending on stock price, which remains competitive in the financial sector. The payout ratio has crept up to around 40 to 50% of earnings, still within sustainable range, but watched closely by analysts. So the key question, is Prudential's dividend safe going forward? Strengths: 150-plus year history of financial management, survived multiple economic crises, diversified revenue streams across insurance, retirement, and international markets. Moderate payout ratio leaves room for sustainability. Strong regulatory capital position concerns. Low interest rate environment pressures investment income. Demographic shifts affect life insurance demand. Increased competition from fintech and alternative financial services. Regulatory changes could impact capital requirements. Economic recession could pressure earnings. Verdict: Prudential's dividend appears sustainable in the near to medium term based on current earnings, capital position, and historical management philosophy. However, dividend growth may remain modest, 2 to 5% annually, rather than the explosive growth seen in the 2010s recovery. Income investors seeking stability over growth may find PRU attractive, especially at yields above 5%. From 1875 to 2024, Prudential's story is ultimately about resilience. The dividend history reflects not just payments to shareholders, but a company's ability to navigate depressions, world wars, financial crises, and pandemics while maintaining its core commitment to financial stability. Yes, there have been cuts. The 2008-2009 reduction was significant, but compared to peers who suspended dividends entirely, Prudential's approach showed both pragmatism and long-term thinking. For dividend investors, Prudential offers a 5-6% current yield of $150, year track record, a reasonable payout ratio, diversified business model. It's not a dividend aristocrat with 25-plus consecutive years of increases, but it is a dividend survivor. And in the insurance industry, that matters. Whether Prudential belongs in your portfolio depends on your goals, risk tolerance, and income needs. But one thing is certain, after 150 years, the Rock of Gibraltar continues to stand. Thanks for watching. If you found this analysis valuable, please like, subscribe, and check out our other dividend history deep dives.